Welcome back to the Talking Hedge, your cannabis business podcast. I'm Josh Kincaid. Let's say you're a criminal with millions of dollars in ill-gotten gains, but there's one problem. Transferring that money or carrying suitcases of cash will raise eyebrows, so you need to launder the dough and make that dirty money appear to be the proceeds of legitimate enterprise. So it can be spent anywhere around the world on real estate or luxury yachts with no questions asked. Most countries and all the major world's banks have controls in place to flag suspicious funds coming into financial systems. One way of money laundering is hiding under shell companies. UK-based shell companies are one way of doing it. As noted in the Panama Papers, you can have deliberately opaque shell companies which exist only on paper and have no active business operations. They're easily and cheap to set up and effective at obscuring ownership. So they're key to what experts are calling the layering phase of money laundering, in which funds are shoveled around multiple times to make them harder to track. Shell companies are often found in traditional tax havens such as Switzerland, the Cayman Islands, which is British, and US of Delaware and Nevada are also permit corporations to be set up in anonymity. So the International Consortium of Journalists has uncovered the Troika laundromat scheme, says it involved at least 75 shell companies that generated a total of $8.8 billion in transactions through made-up deals. There's been a global push for more transparency, even in the UK. Number two is finding weak links. After the chaotic collapse of the Soviet Union, launderers searched out weak spots in Europe where watchdogs were ill-equipped. They looked for cannabis banks that might be poorly supervised or even open to be complacent. Torrents of cash were channeled through banks in Cyprus and Malta. Baltic nations of Estonia, Lithuania, Latvia all have central roles in the emerging tales of dirty Russian money, becoming big players as passageways to the West. The former Soviet states had an added draw because Russian is widely spoken. The Scandinavian leaders rushed to get into the high-growth markets. By way of Western correspondent banks, funds could be further cleansed and moved around with less scrutiny. Denmark Bank has acknowledged that much of about $230 billion has flowed through its tiny Estonian outputs that may have been dirty. There's trade-based money laundering, where criminals can move around funds across borders by engaging in seemingly legitimate international trading of goods and falsifying invoices to disguise their true value. Such trade-based laundering was key to the Troika laundromat scheme, where bogus invoices were allegedly used to trade food goods, metal goods, auto parts. So the method is widely used to enable outflows from developing countries. Global Financial Integrity, a Washington-based research organization, estimated that trade misinvoicing accounts for 18% of developing nations' trade with developed economies. Wow. 1 in every $5 is fraud from emerging markets to first world countries. Mirror trades have two stock transactions, so in two separate locations, effectively canceling out each other, but succeeding in moving money from one place to another. A mirror trade have legitimate uses, so they're employed by mutual funds and other investors that have limits on where they can hold securities. But such trades can also be used to bring money across borders. So in one infamous example, Deutsche Bank helped a client move $10 billion out of Russia from 2011 to 2015 by executing mirror transactions in its offices in Moscow and London. The bank was fined $629 million by the UK and US authorities for those compliance failures. A criminal investigation by the US Department of Justice has yet to conclude. Another technique, sometimes known as back-to-back deal, is to take a loan in one country that's secured by a deposit in another. The launderer defaults on the loan, the bank seizes the deposit, and the money looks clean. The fact that both types of transactions have legitimate applications makes them harder to stop. Mixing clean and dirty money, it's difficult to tell the difference between legitimate businesses and illicit flows from criminal activity. Launderers sometimes work with real companies that generate lots of cash, managing their funds before they head back to the bank. So casinos and other cash banks operations, such as restaurants, are attractive targets. A common scheme involving casinos is to buy large amounts of chips in cash, gamble just a tiny share, and then call the rest winnings and redeem the funds. Even more effective is owning the whole casino. Macau, the world's largest gambling hub, has long been beset by money laundering despite repeated attempts by China's government to rein it in. Canada found last year that casinos in British Columbia for years served unwittingly as laundromats for domestic and international crime. The expansion of online gaming and sports betting, where identities are easy to conceal, provide new opportunities, as do cryptocurrencies. Smurfing is another way of money laundering. And to avoid raising red flags, money launderers will break down a large amount of money into smaller chunks and have associates known as Smurfs deposit those funds in different accounts in different places. U.S. banks are required to report to regulatory authorities any transaction more than $10,000. So launderers often avoid hitting that limit. Banks must continuously track customer transactions to look for red flags. And if they have any good reason to suspect something devious, they must also alert authorities for a suspicious transaction report instead of a currency transaction report. Failure to do so can bring stiff fines. Banks often complain that the rules are difficult and too costly. And with that, we're going to roll this one up. If you want to like and subscribe and share, please do. If not, I'm out.